In this next section, we will be looking at the reduction of debt sections of section 19 and paragraph 12A of the H schedule. This section is quite popular. It's still fairly new in the bigger scheme of things, and it is quite often asked also as discussion question or for some discussion points. But students tend to not have a great understanding of what this tries to achieve. So before we even look and go into all sorts of detail and so forth, I'm going to try and explain to you what this section is trying to avoid or what the situation is here. Right, so let's assume that we have a company called X Limited. Right, X Limited. Now basically what X Limited does is X Limited goes to the bank and it gets R1,000,000 from the bank. It then takes that money, so it's like a loan. It takes that money and let's say it pays for something which it can claim a deduction for. So I'm going to just for now say, let's say they went and they spent money on salaries and wages, so they can claim R1,000,000 deduction because they've incurred expenditure in the production of income, and therefore in terms of section 11A, they can claim a deduction. Right, so that all seems pretty normal and above board. But now, let's say this outstanding loan of R1,000,000. At some point later, the bank goes to X Limited and says, for whatever reason, you don't have to pay back that R1,000,000 anymore. We're writing the loan off. So basically, for the bank, they now have R1,000,000 which is being written off, so they potentially have a capital loss. If it's not a bad debt, it won't necessarily be a bad debt because it's not a bad debt. They've written it off, right? And X Limited has this gain because instead of paying R1,000,000 back in future, they don't have to pay it back anymore. Now, what do you think the issue with this is for SARS and for the legislator? They go and say, right, we gave you R1,000,000 as a deduction because we expected you to pay R1,000,000 at some point in the future. The fact that we gave you a deduction, but your actual cash flow now is not R1,000,000, it's null or R1,000,000 or less, in this case null, is an issue for us. And we want to fix this situation, and for that we have section 19 and paragraph 12A of the Act. Right, so basically what you'll see is it gives you up here in the notes, it basically gives you the same information. Please note paragraph 12A will apply to the capital gain section, and section 19 is basically a recoupment section. Right, but what is very important is that you understand this R1,000,000. Remember, I'm going to go back to the example the whole time. I went to the bank and I got R1,000,000 from there. This R1,000,000, which is now being written off, it is important that you know if you spend that R1,000,000 on a capital asset or something which is not capital in nature. Now, if it is not capital in nature, you'll only look at section 19, and this will also include inventory as being not capital in nature. But it will include other deductions like salaries and stationery repairs, anything which you could claim deductions for. If you purchase a capital asset, then you'll have to consider section 19 and paragraph 12A. And paragraph 12A you'll have to consider for the capital gain side of the asset. Section 19 is typically, again, has to do with the recoupments. Please note also, this capital asset over here applies to capital assets on which we can claim allowances, and also capital assets where we can claim no allowances, like land, for example. Okay, so first one I want to talk about is inventory. So I went and I spent my money, that loan from the bank, on inventory, and then I wrote it off. So section 19.4 and section 8.4a tell us what to do with this. Okay, so what it says is, it says for the stock that is still on hand, take the debt reduction amount. Now the debt reduction amount is the amount of the loan or debt that I owe someone that's been written off. So in my example where the bank gave us R1,000,000 and the full R1,000,000 was written off, the full million is a debt reduction. If the bank gives me a loan, let's say of R1,000,000, but they say only pay us back 800,000 rands, then the loan reduction is the 200,000 rands difference. All right, that's the loan reduction amount. So that loan reduction amount, if the stock is still on hand, we knock it off against the cost of the stock, so we turn the stock cost into nil. And if the stock is not on hand, we recoup it under section 84A, the difference. And if you refer back to our recoupment lecture, it works in the same way there. Again, remember all of the rules. It cannot exceed past allowances. Okay, there is an example on this in your lecture examples. Then, if it is any other expenses, so not inventory or an asset, so this is anything where I claim the deduction, but there's no real asset attached to it, if for that matter. This will be, for example, paying salaries and wages and stationery and so forth. The full debt reduction amount is recouped under section 84A. Okay, and then, guys, the assets. This is how it works. This is the simplest way of seeing it. We get two types of assets. We get allowance assets, and we get assets with no allowance. Assets. Right. So, this is the steps that we follow. If the asset has an allowance, we will first reduce the base cost by the debt reduction amount. If there's anything left or there is no base cost, then we reduce any capital losses that the company has. And if we've reduced the capital loss and there's still left, the rest is a recoupment in terms of section 19, because there was allowances granted on it. If there are no allowances granted on assets such as land, we will first reduce the base cost. If the base cost has already been reduced to null, or if the asset is no longer in hand, we'll reduce the capital the capital loss. And if there is anything left, there's no further effect, because there cannot be a recoupment. Why not? Because what's the golden rule for recoupments again? You can't recover or recoup more than the past allowances. If there were no allowances granted, then there was no recoupment taking place. So, guys, turn to lecture example 4. Right, lecture example 4. So the first one shows us inventory, what we do with inventory. A Limited is a registered VAT vendor with a 31 December year end. All amounts below exclude VAT. Again, I remind you, you need to remember to consider section 23 capital C for VAT. This is not the VAT Act section, this is in the Income Tax Act, but this tells you what to do with VAT. In a nutshell, if you could claim the input VAT, you have to exclude it from the cost for income tax purposes. Same with paying salaries or making sales. Because you raised output VAT, the amount that you include in income tax excludes VAT. Okay, but please be aware of section 23C. Right, so A Limited purchased 100,000 units of inventory at 10 rands a unit on the 1st of February 2015. So what I want you to see right away from the solution side is that we got a deduction for that. 100,000 times 10 rands under section 11A. A Limited then sold 20,000 of these units on the 1st of March at 15 rands a unit. So that is gross income for us. 20,000 times 15. A Limited ran into severe cash flow problems and could not settle the amount owing to XXX Pty Limited. As A Limited is XX Pty Limited's largest customer, XXX Pty Limited agreed to write off 900,000 rands of the outstanding debt. So the first thing you need to see is that the 900,000 rands is our reduction amount. So what are we going to do with it? We bought 100,000 units and we sold 20,000 of those units. So that means we have 80,000 units which are left. Now, if you remember what section 19.4 said, it basically says first reduce the cost of the units. So, the reduction of debt. 800,000 rands of my 900,000 rands debt reduction amount, I add back to income because I'm actually reducing the cost that we incurred on 80,000 of those 100,000 units. What I want you to see now, which is very important, is that those 80,000 units will still be on hand at the end of the year, but their cost is now considered to be null. Why? Because we've reduced it to null with the reduction amount. Now, our reduction amount was 900,000 rands. We've used 800,000 to reduce the inventory balance to null. So the 100,000 that remains is a recoupment for us. Example 4.2. This example illustrates a situation where a debt reduction amount was incurred on deductible expenditure and not inventory or an allowance asset. So A Limited is registered VAT vendor, all amounts below exclude VAT. They obtained 200,000 rands to pay salaries as a loan, and then the creditor wrote off it and said, listen, you don't have to pay us anymore. So what happens for us? Right? The salaries, we get a deduction for that, right? And we will have to add the amount back. Sorry guys, I've just realized also when I'm looking at it here, it says 100,000 rands here. If I can just ask you, I'll also amend it in your actual question. Please make that 100,000 rands over there in example 4.2. Right, please make it 100,000. If you are on our course, you'll find the updated question of the updated amount. All right, and then example 4.3. So this example illustrates an asset with no allowances and what happens then. So just to remind you, if the asset has no allowances, we're going to be following this information here. We're first going to reduce the base cost, then the capital loss, and there will be no further effect if anything else is lost. So X Limited took out a loan of R1 million from a bank that is used to finance the purchase of a piece of land. 1 year later, when the loan was still outstanding, the bank agreed to write off the loan if X Limited paid 100,000 rands. So the reduction amount is a million less 100,000 rands, 900,000 rands. Okay. B. What are the tax consequences if the land is still on hand? If the land is still on hand, step 1 in our note said we need to reduce the base cost. So the base cost was $1 million, we reduce it by 900,000, so this is the new base cost. So when we sell this land eventually, our base cost will no longer be $1 million, it'll be 100,000 rands. So we'll have a greater capital gain presumably. C. What is the tax consequences of the above if the land was no longer on hand at the time of the reduction of the debt? Right, so what do we know? What do we have to do? We reduce the base cost. Okay, let's clean up a little bit here. We reduce the base cost, then the capital loss, and that's it then. So we will reduce the capital loss next. Now, in this case, we were not given any capital losses, so there's no further effect. But if you look at D, what happens if there was a capital loss of 480,000 rands? So basically what it means is our capital loss was 480,000. We have 900,000 rands to reduce it by. We can only reduce it down to 0, so now we don't have a capital loss anymore. The difference between the 900,000 and the 480 that we used above here, the 420, there will be no further tax effect because it is an asset with no allowances on it. Example 7.4 will now show us an allowance asset. So I'm just going to take you back. Remember what we do with an allowance asset. We reduce base cost, then we reduce the capital loss, and if anything is left, we will do the recoupment. Right, so X Limited bought a new manufacturing machine. That means we get Section 12C allowances for R1 million on credit from a supplier, and they bought it into use immediately in 2013. In 2015, no amount of the debt has been repaid. The supplier agreed to write off the debt amount. So they say, you don't have to pay us that anymore. X Limited had a capital loss of 300,000 rands brought forward from the previous year. So then I ask you, you are required to calculate the tax implications of the above. You may assume that the base cost of the machine at the date of the debt reduction is 200,000 rands. So guys, our reduction amount is $1 million. What are we going to do with the $1 million again? We're going to deduct it against base cost. If anything is left, we're going to deduct it against the capital loss. If anything is left, it's a recoupment in terms of Section 19. Right, so first up, we have a base cost of 200,000 rands. So we take $1 million rands. There's the base cost. We take 200,000 of our million and we reduce the base cost to 0. So it has a brand new base cost of 0. That means we've already taken 200,000 rands off the $1 million rands and we've got 800,000 rands left. Okay, then they tell you in the question that there was also a 500,000 rands capital loss. Sorry, a 300,000 rands capital loss. So we take that 300,000 rands capital loss and we reduce it to nil. So now we've used 200 and 300,000 of our million rands. There's 500,000 rands left. That 500,000 becomes a recoupment under section 19. And that is section 19 and paragraph 12a. It is an important section, guys, but as you can see, if you just follow the basic steps and steps here, it is quite simple. Please make sure to go and work through the rest of paragraph 12a and section 19 for things which are excluded and where it's not applicable. Thank you very much, guys.